Hey everyone, and welcome. Today, we are diving deep into something that's absolutely critical for anyone trading on the Colombo Stock Exchange, the different types of orders. We're going to go from just blindly clicking buy to being a strategic trader who is in complete command of every single move you make. Let's get right into it. So, let's kick things off with a scenario that, let's be honest, has made countless new investors pull their hair out. You see a price you like, 150 LKR. You place the order, but when you check your account, you were charged 152. What happened? It feels like you got ripped off, but I promise you it's not a mistake. It's all about understanding how the market really works, and today we are going to solve this exact puzzle. To get to the bottom of our price mystery, we first need to look at something you might not even realize is an option: order validity. It sounds complicated, but it's really simple. It just means how long your order stays active and open in the market before it just disappears. This is step one to taking back control. Okay, so this slide breaks down the two most common choices you'll see. First, you've got a day order. This is usually the default setting. It means your order is live for just one trading day. And if it doesn't get filled by 2:30 p.m., poof, it's gone. Perfect if you're an active trader. On the flip side, you have GTC, or good till canceled. This is for the patient investor. You can set your absolute dream price to buy a stock, and that order will just sit there waiting for weeks or even months until the market comes to you. Then we've got the GTD, or good till date order. Now this gives you surgical precision. Imagine you know a company is releasing its earnings report next Friday, and you think the stock might take a temporary dip. Well, you can set a buy order that is only active until that specific day. It's an amazing tool for trading around known events. Now for a couple of the more advanced types you might bump into: IOC and FOK. Think of these as high-speed, right-now commands. Immediate or cancel, or IOC, says, hey, get me as many shares as you can this very second, and just cancel whatever's left. Fill or kill, or FOK, is more demanding. It's an all-or-nothing deal. It says, if you can't get me my entire order right now, forget the whole thing. These are pretty specialized, but it's good to know they're in the toolkit. Okay, so we've covered the when, how long an order is good for, but that only gets us halfway to solving our little mystery from the start. The most important piece of the puzzle is the how much, the type of price you agree to when you place that trade. And this brings us to the absolute core dilemma that every single trader faces every single day. Do you prioritize speed, getting the trade done immediately no matter what? Or do you prioritize price, getting that exact price you want, even if it means you might miss the trade? This choice, it's everything. And here it is. This is the answer to our mystery. A market order is basically the buy it now button of the stock market. It guarantees that your trade will happen, but it does not guarantee the price. The system just grabs the next best available price to fill your order. And that is why you paid 152 LKR instead of 150. You used a market order. And in that split second, the best available price moved up. That's called slippage. Now, a limit order is the complete opposite. It's for the bargain hunter. It guarantees the price, but it doesn't guarantee the trade will happen. It tells the system, I refuse to pay a single cent more than 150 LKR. The risk? The stock might just keep going up, and your order will sit there, never getting filled. Now, this is a piece of advice that is pure gold for anyone trading on the CSE. For stocks that don't trade very often, low volume stocks, the gap between what sellers are asking and what buyers are bidding can be huge. That gap is called the spread. Using a market order on these stocks is so risky because you can end up paying way more than you intended, killing your potential profit before you even begin. So we have totally cracked the code on how to buy with precision. But what about the other side of the coin? What happens when a trade goes against you? How do you protect your hard-earned capital from a big loss? Well, that's where your trading insurance policy comes in. I absolutely love this quote because it captures a massive shift in mindset. An amateur trader buys a stock, watches it fall, and just hopes it'll come back. A professional trader doesn't hope. They have a predefined exit plan, a stop loss, that protects their money if they're wrong. Let's just walk through exactly how this works. It's super simple. Let's say you buy a stock at 100 LKR. You decide, okay, the absolute most I'm willing to lose on this is 5 LKR per share. So you set a stop loss trigger at 95 LKR. If the stock price drops and even touches 95, your system automatically fires off a market order to sell you out of the position. Boom! You take a small, manageable loss and you live to trade another day. No emotion, just a plan. Now listen closely, because there's a subtle but really critical difference here. A standard stop loss, when triggered, becomes a market order. Its job is to get you out, period. A stop limit, on the other hand, becomes a limit order. It guarantees your price. But here's the danger. What if a stock gaps down? Let's say it closes at 96, but some bad news comes out overnight and it opens the next day at 90. Your 95 LKR stop limit order would never get filled because the price blew right past it. You'd be stuck in a free-falling stock. And for those of you who really want to level up your game, there's the trailing stop loss. This is a brilliant, brilliant tool. It automatically moves your exit point higher as the stock price goes up. So it protects you on the downside, but it also lets your profits run, locking in your gains as the stock climbs without you having to manually adjust it every 5 minutes. It's a game changer. All right, so we've got all these individual tools, validity, price types, stop losses. Now for the fun part. Let's see how the pros combine these to create really smart, effective trading strategies. Here are a few powerful combinations you can use. The patient investor might use a GTC limit order to wait for that perfect discount. The active trader, who needs speed, might use a day market order. The strategic planner, who's trading on news, could use a GTD limit order. And most importantly, the true risk manager adds a stop loss to every single buy order they place, defining their maximum risk before they even enter the trade. And that brings us to the final and maybe the most important rule of all, one that's used by pretty much every successful trader I know, the 1% rule. It's simple. Never, ever risk more than 1% of your total trading capital on any single trade. Your stop loss should be placed at a level where, if it gets hit, that loss is just 1% of your account. This is how you stay in the game long term. So, there you have it. You are no longer just a passive person clicking a button. You now have the full toolkit to control your entry price, your exit price, and most importantly, your risk. You've officially moved from guessing to strategizing. So the real question is, how are you going to place your next trade? We really hope this explainer has given you some new tools and the confidence to navigate the market like a pro. Thank you so much for watching, and for more content just like this, make sure you visit us at King's Academy. We would honestly love to know what you think of this explainer. Your feedback is so valuable. It's what helps us make our content better and better. So please, drop us a line in the comments section below. And of course, if anything was unclear or if you have any questions at all, just ask. We read through the comments and we'll do our best to address everything as soon as we can. Until next time, happy trading!